Meet John and Noah. They are both 30 years old, same city, same $75,000 income a year, same financial discipline. Both managed to save $60,000 over the past few years. Same ambition, same desire to build something real. The only thing different is what they decide to do with that $60,000. John puts it toward a down payment on a rental property, a solid 3-bedroom house in a decent suburb, listed at $300,000. He puts 20% down, that's his $60,000, takes out a 30-year mortgage at 7%, and finds a tenant willing to pay $2,100 a month. His monthly mortgage payment is around $1,600. On paper, that's $500 a month in positive cash flow before anything else touches it. John does the math on a napkin, likes what he sees, and signs the papers feeling like the smartest person in the room. Noah takes the same $60,000 and drops it into a total stock market index fund. No research, no analysis, no thesis. He sets up a $400 automatic monthly contribution and genuinely forgets about it. His co-workers ask what he's investing in. He says, index funds. They nod politely and change the subject. Nobody's impressed. On day one, John has a physical asset, a real address, a tenant, and a story to tell. Noah has a confirmation email and a portfolio balance that doesn't feel like anything. From the outside, John is winning by a mile. But this is where the real story starts. For John, the first year feels like a dream. Rent hits his account on the first of every month. He drives past the property on his way to work and thinks, I own that. He's claiming mortgage interest on his taxes, shaving money off his bill. He's building equity with every payment. The house feels like it's working for him around the clock. And it kind of is. His $300,000 property appreciates roughly 3 to 4% in year one. That's $9,000 to $12,000 in paper gains on a $60,000 investment. His actual equity grows. The math feels like leverage working exactly the way it's supposed to. Noah, meanwhile, has watched his $60,000 grow to about $66,000. He's added $4,800 in contributions. His portfolio is sitting around $71,000 by the end of year one. He did exactly nothing to get there. But John is still winning the dinner party conversation. And for now, that feels like it counts for something. By year three, John has collected roughly $75,000 in rent. His mortgage payments total about $57,600. Gross cash flow, $17,400. Sounds incredible. That's almost $500 a month, every month for 3 years straight, until you start subtracting what actually happened. Property taxes, $3,500 a year. Insurance, $1,800 a year. He's already replaced the water heater, $1,400. Had a roof repair after a bad storm, $2,200. Lost 1 month of rent between tenants, plus $700 to clean and relist. Had a plumbing situation that cost $900 on a Sunday. That's not a horror story. That's a normal 3 years of owning a property. After every real cost, John's net cash flow over 3 years is somewhere between $3,000 and $5,000 total, not $17,000, $3,000 to $5,000 over 3 years, while managing phone calls, coordinating repairs on his lunch break, and doing 2 rounds of tenant screening. Noah's portfolio at year 3, approximately $90,000 to $95,000. He contributed $60,000 up front and $14,400 in monthly additions. The rest is compound growth. He spent 0 hours managing anything. John still has his equity working for him. The property is now worth around $325,000 to $335,000. His remaining mortgage balance is roughly $230,000. His equity is somewhere around $95,000 to $105,000. That's real wealth, and a lot of it came from the bank's money. But what nobody talks about is what it cost him to get there, not just in dollars, in hours, in stress, in Sunday afternoon plumbing emergencies. The equity is real, but so is the price tag on your time. By year 5, John is on his second tenant, almost his third. He's raised rent to $2,250, which helps, but his property taxes went up. His insurance renewed higher. He had an HVAC issue that cost $4,800, and he couldn't postpone it because it was August and his tenant was threatening to leave. His actual cash-on-cash return, the real money he pockets relative to his original $60,000, is hovering around 3 to 5% after everything. Not bad, but not the wealth-generating machine the napkin promised. And here's what's become clear by year 5. John isn't just an investor. He's a landlord, and being a landlord is a job. It's a part-time job he didn't fully price in when he signed the papers. The income is real, but so is the labor. Noah's portfolio at year 5, somewhere around $130,000 to $145,000. He still hasn't done anything. He hasn't called anyone. He hasn't made a single decision since the day he set up the automatic contribution. His money is working. He is not. But here's the uncomfortable question that nobody asks at year 5. Is John building wealth? Yes. Is Noah building wealth? Also, yes. So what's the actual difference? The difference is what each of them is trading to get there. John is trading time, stress, concentration risk, and active management. Noah is trading volatility, cash flow, and the psychological challenge of watching a number go down sometimes without panicking. Both trades are real. Neither is free. At year 10, something interesting happens. The gap that looked so obvious in year 1 starts to close from an unexpected direction. John's property is now worth roughly $400,000 to $420,000. His remaining mortgage is around $200,000. His equity sits at approximately $200,000 to $220,000. He's had 10 years of rent coming in, but after all real costs, mortgage interest, taxes, insurance, repairs, turnover, one major renovation, his total net cash profit above what he spent is somewhere around $15,000 to $25,000. His total investment position, equity plus cumulative cash flow, may be $215,000 to $245,000. Noah's portfolio at 10% average annual return with consistent $400 monthly contributions, approximately $200,000 to $220,000. He put in $60,000 up front. He added $48,000 in contributions over a decade. The other $90,000 plus is pure compounding. He never made a single active decision. At year 10, they're shockingly close. John might be slightly ahead, thanks to leverage, but John also spent hundreds of hours managing his investment. John took on $240,000 in debt. John concentrated his entire investment in one house, on one street, in one city. One bad flood, one prolonged vacancy, one difficult tenant, and his numbers look significantly worse. Noah diversified across thousands of companies across the entire global economy without thinking about it once. The dollar amounts are nearly identical. The lived experience is not even close. And this is where most people stop the analysis. But we're not stopping here. Because the next 10 years are where the real answer lives. Before we get to year 20, I need to say something that most finance content refuses to say. The real estate versus stocks debate has almost nothing to do with returns. It has everything to do with identity. John doesn't just own a rental property, he is a landlord. That's how he introduces himself at parties. That's how he thinks about his financial future. The property is tangled up in his sense of who he is and how he's building his life. Noah doesn't have an identity attached to his investments. He just has a number that grows. It doesn't feel like anything. It doesn't come up in conversation. He can't drive past it. And here's what that difference actually costs both of them. For John, the identity is motivating, but it's also a trap. It's hard to exit an investment that you've wrapped your self-concept around. It's hard to admit when the numbers aren't working, when the market shifts, when the labor isn't worth it anymore. The emotional attachment that made him a disciplined investor can also make him a stubborn one. For Noah, the lack of identity is a superpower, but only if his discipline holds. The reason most stock market investors underperform the market isn't the market, it's their behavior. They check the balance every day. They panic when it drops. They sell when it hurts. They buy back in after it recovers, which means they buy high and sold low, and they locked in the loss they were trying to avoid. The stock market's historical average assumes you stayed invested through 2008, through March 2020, through every gut-wrenching drop that felt like the end of something. Most people don't. Most people flinch. John's rental property protects him from flinching. He can't panic sell a house in a day. The friction that makes real estate annoying is the same friction that keeps him invested. Noah's index fund is only as good as his discipline. This is the variable neither investment can guarantee. At year 20, John's property is worth somewhere between $540,000 and $600,000. His mortgage is nearly paid off or done entirely. His equity is massive. Call it $500,000 to $560,000, and he's been collecting rent the entire time. But after 20 years of maintenance, turnover, taxes, insurance, 2 major repairs, 1 tenant dispute that cost him 3 months of lost rent and some legal fees, his cumulative net cash profit, rent minus every real dollar out the door, lands somewhere around $50,000 to $90,000 above what he spent. Total position, equity plus cash flow, somewhere between $550,000 and $650,000. Not bad. Really not bad. That's life-changing money built on a $60,000 investment. Noah's portfolio at 10% average annual return with $400 monthly contributions over 20 years, approximately $500,000 to $560,000. He contributed $60,000 upfront and $96,000 over time. The other $350,000 plus is compounding. He spent exactly 0 hours managing it. He took 0 phone calls. He replaced 0 roofs. They end up in the same ballpark. And here's the part that actually changes the math. If Noah had increased his contribution by even $150 a month, bringing it from $400 to $550, his 20-year total jumps to roughly $640,000 to $700,000. No extra work, no extra risk. Just a slider moved slightly to the right. If John wants to scale, he buys another property, another mortgage, another tenant, another set of weekend emergencies. Scaling real estate is a staircase. Every step costs something beyond money. Scaling index funds is frictionless. You just add more. That asymmetry is quietly one of the most important things about this comparison, and almost nobody talks about it. Let me be specific, because vague conclusions are useless. Real estate wins when the rent-to-price ratio works in your favor on day one, when monthly rent is at least 0.8 to 1% of what you paid for the property. In most major U.S. cities right now, that math is nearly impossible. Median home prices in the $450,000 to $500,000 range, with median rents around $2,100 to $2,200. You're looking at a 0.45% ratio. The cash flow turns negative from day one before you account for a single repair. Real estate wins when you treat it as a business, not a side hustle, not a passive income fantasy. Serious tenant screening, dedicated maintenance reserves, systems that reduce your time involvement. If you're going to run it like a business, the returns can genuinely beat the stock market, especially with leverage, but it requires you. It requires your time, your judgment, your active presence in the investment. Real estate wins with house hacking, living in one unit and renting the others. This can eliminate your own housing cost entirely while building equity. The stock market simply cannot do that. Stocks win when you haven't yet maxed your 401k employer match. That match is an instant 50 to 100% return on every dollar before the market does anything. Nothing in real estate touches that. Stocks win when you live in a high price-to-rent ratio city where the rental math simply doesn't work. Stocks win when you might move, when you want liquidity, when you don't want your investment to require you. Stocks win when your discipline is real, when you can actually hold through a 40% crash without selling. And for most people earning $65,000 to $100,000 a year, the honest answer is some version of both. Buy a modest primary residence. Max the 401k match. Fill a Roth IRA. Put the rest in a low-cost index fund. That's it. That's the formula. It's boring. It works. It doesn't have a thumbnail. At year 20, John and Noah are both sitting on life-changing wealth. John has a paid-off house, a story, and calluses from 2 decades of being a landlord. He knows his neighborhood, knows his contractor, knows exactly what a water heater installation should cost. He built something tangible. He can point to it. His kids drove past it growing up. Noah has a portfolio balance, a quiet sense of discipline, and the same 168 hours in his week that everyone else has. Except his investment never took any of them. He retired his money. He kept his time. Neither one made a wrong choice. They made different ones. And they both stuck with them. The third friend, the one who bought at the peak, sold during the crash, jumped into crypto, tried a rental that bled cash, switched back to stocks at exactly the wrong moment. That friend has $180,000 at year 20 and a long list of reasons why nothing worked. That's not a story about bad investments. That's a story about the most expensive thing in personal finance: switching. Switching strategies, switching asset classes, switching philosophies every time something stops feeling good. That's where the real money gets lost. Not in the market, not in the real estate cycle, in the gap between what someone plans to do and what they actually do when it gets hard. So here's the only question that actually matters. Not which investment wins. Not which asset class has the better historical return. Not which one sounds smarter at a dinner party. Which one are you actually going to hold for 20 years? Which one are you going to keep buying when it stops feeling exciting? Which one are you going to stay in when it drops, breaks down, sits empty, or bleeds you in ways you didn't see coming? John's rental property made him wealthy. Noah's index fund made him wealthy. Their discipline made both of them wealthy. Pick the vehicle you'll actually drive, not the one that looks fastest on a spec sheet. Because the richest version of you isn't the one who picked the right asset. It's the one who stayed in the game long enough to find out it didn't matter which one.